This is a presentation on book-to-tax, permanent and temporary differences arising from intercompany transactions between a U.S. parent corporation and its foreign subsidiaries. We'll start by looking at the financial effects of the U.S. parent company, assuming that it owns 100% of the foreign subsidiary and accounts for this investment in their books by using the equity method. Then we'll explain the tax consequences of having a permanent reinvestment of foreign earnings. Next, we'll introduce an example of a temporary difference that could occur when intercompany transactions take place between the U.S. parent corporation and the foreign corporation. We would like to start with an example of U.S. parent corporation with a fully owned foreign subsidiary in China. Assume that throughout the year the foreign subsidiary had net income of $2.5 million US and it paid $100,000 in dividends to the U.S. parent. Now, how would these amounts be reflected in the U.S. parent's books? Well, first of all, the moment the U.S. parent acquired the foreign subsidiary, the U.S. Corp had to create an investment account in the foreign subsidiary and debit that account by the acquisition price, which is, in our case, $4 million. Also, let's assume the U.S. parent chose to record its foreign subsidiary's transaction under the equity method. Therefore, if the foreign subsidiary had $2.5 million of net income, then the parent would record an increase in the investment in sub account by debiting it by that amount and crediting the equity account in the foreign sub income to reflect the effect of an increase in earnings. If the foreign sub pays out a dividend of $100,000 to the parent corp, then the U.S. parent corp would receive cash and debit that amount from that account and credit the investment in foreign sub to reflect a decrease in the value of the actual investment in the foreign subsidiary. It is possible, however, that the foreign subsidiary does not declare or distribute a dividend to its U.S. parent. In this case, the money the parent would have received is reinvested in the foreign subsidiary. Since the money remains in the foreign country and is not distributed to the parent corp, no dividend entry should be made. Instead, this amount would be a part of the whole foreign subsidiary income, so the dividend amount would be reflected in the U.S. parent's books as an accrual of the subsidiary income, and we would debit the investment account and credit the equity in foreign subsidiary account. This creates a temporary difference since the income of the foreign subsidiary is recognized in the consolidated income for financial purposes, but for tax purposes, the income is not taxed until it is repatriated, or in other words, brought into the United States. In this case, a deferred tax liability would be credited and a deferred income tax expense debited equal to the amount of income tax payable the parent expects to owe upon eventual repatriation of earnings. However, this temporary difference can be treated as a permanent difference if there is sufficient evidence that there will be an indefinite duration of the reinvestment of dividends. FAS 109 requires specific disclosures in the financial statements for treating temporary differences as permanent, explaining the amount of the difference and the reasoning as to why it can be treated as a permanent difference. As long as there is no repatriation of earnings from the foreign subsidiary, the parent will not be taxed for federal income tax purposes. Since there is a permanent difference, no DTL would be recognized, so the tax rate reconciliation would start with its pre-tax book consolidated income of $10 million, and assuming a 35% federal tax rate, we would have $3.5 million of U.S. tax. However, because the subsidiary income is kept in China, it creates a permanent difference if an APB 23 exception is used. So the $2.5 million subsidiary earnings times 35% federal tax rate will yield a $875,000 decrease in the U.S. tax. The $875,000 divided by the $10 million consolidated income will decrease the statutory U.S. tax rate of 35% by 8.75%, resulting in a total 26.25% effective tax rate. Let's take a look at a temporary difference.
An international subsidiary sells a good to a U.S. parent. This transaction creates a temporary difference because the tax law on this issue is quite different from the financial accounting rules. Tax law refers to intercompany transactions as transfer pricing. Let's look at an example. Parent company is a U.S.-based furniture company that has a wholly owned subsidiary wholly owned Chinese subsidiary S Company. During the year 2010, S Company makes 10 tables at a cost of $250 each and sells these 10 tables to its parent company for $600. On that same day, P pays S Company in cash. To make this example easy, we're assuming that P Company pays in dollars. We will discuss the issue of foreign exchange in a moment. At the end of 2010, P Company sold 8% or 8 tables to outside customers for $1,000 and had the other 2 tables in inventory at the end of the year. U.S. GAAP requires The foreign wholly owned subsidiaries file consolidated financial statements with the U.S. parent. The consolidating journal entries are similar to those we have learned before. First, a journal entry needs to be made to eliminate the effects of intra-entity transfers of inventory. A debit to sales and a credit to cost of goods sold of $6,000 is made. This is the TI journal entry. The second journal entry is to remove the unrealized intra-entity gross profit. This is done by debiting cost of goods sold and crediting inventory for $700. The consolidated financial statements will look like this. The consolidated net income is $6,000. When consolidating financial statements that involve a foreign subsidiary, a currency translation must take place of the financial statements. Accounting Standards Codification 830-3045 states that a company must use the current rate method to translate the foreign financial statements. For financial accounting, intra-entity transfers are the same if they are domestic or international. The only change is if there is a currency translation. For tax purposes, intra-entity transfers become very complicated. These transactions are referred to as transfer pricing. The purpose of transfer pricing is to ensure that a company is not avoiding taxes by recognizing a gain in a country with a very low tax rate. To give an example of how a company could avoid taxes, let's say the US has a tax rate of 35% and China has a rate of 2%. Any company would want to keep as much profit in China as possible to avoid US taxes. The subsidiary in China would sell an item to its US parent for a very high price to keep the profit in China. The US parent would then sell the item for a very small profit, paying virtually no taxes on the transfer. Transfer pricing comes in to make sure this does not happen and that the company pays its fair share of US taxes. Unlike financial accounting, a foreign sub cannot file a consolidated tax return with the U.S. parent under Code Section 1540 B3. The price that one entity in a group sells a good to another entity in the group must be done at an arm's length price. Congress enacted Code Section 42 to ensure that the related corporations report their fair share of income in the United States. Code Section 6662E was also enacted to apply penalties to pricing that they do not seem as arm's length. There are a few methods that are allowed to determine the price one entity sells to another. They are uncontrolled price method, resale price method, cost plus method, comparative profits method, and profit split method. The main issue is to see what price unrelated entities would sell the goods to each other. These methods try to match what would happen if the companies were unrelated to make sure enough is taxed in both jurisdictions. Going back to the example before, if we assume all the same facts, that the sub sells 10 tables to its parent, it would have sales of $6,000, cost of goods sold of $2,500, net income of $3,500. And assuming that the tax rate in China is 25%, S company will pay $875 in taxes to the Chinese government. The parent company will have sales of $8,000, cost of goods sold of $4,800, net income of $3,200, a tax rate of 35%, and the taxes paid to the U.S. government of $1,120. Each of these entities will recognize the gain on sale in the year of the transaction because they do not file a consolidated tax return. As was explained before, part of the gain from the two unsold tables was deferred for financial purposes. This results in a temporary book-to-tax difference. The book income from the example was $6,000, and taxable income was $6,700, or $3,500 from the sub and $3,200 of net income from the parent. The book-to-tax difference is $700. Assuming that the tax rate will stay the same the next year, the consolidated financial statements will record a debit to current deferred tax asset of $175 and a debit to deferred income tax benefit for $175. The Chinese corporate rate of 25% is used because that is the jurisdiction in which the transaction takes place. Most likely, the two tables will be sold in the following year, and this entry will be reversed in the next year. The company will also record a journal entry of current income tax expense of $1,995 and the payable also of $1,995, $875 from the sub, $1,120 from the parent. This is for the tax liability owed to both the U.S. government and the Chinese government. We have reviewed both a permanent difference and a temporary difference when dealing with the U.S. corporation foreign subsidiary. These two problems become more complex when you add a non-controlling interest